Welcome to the Deep Dive, your go-to for getting the real insights from the latest earnings calls.
That's right.
Today, we're jumping into Tilly's Inc., ticker TLYS. They've been, navigating some seriously choppy retail waters lately.
We really have. It's been tough sledding for them.
But just when you thought things were looking bleak, their Q2 fiscal 2025 results dropped. And honestly, kind of a surprise. Maybe signaling a turnaround.
Yeah, a potential shift underway, definitely. After a pretty challenging period, these latest numbers, they suggest something's changing, and the market noticed for sure.
Big time. Okay, let's dive in.
So we're going to unpack those figures, see what drove them, and what the company's looking at for the rest of the year.
Let's hit those headline numbers first, the ones that really grabbed attention. GAAP earnings per share, $0.10. 10 cents.
Right, and the expectation, a loss. Consensus was looking for a $1.04 loss per share.
So that's a positive surprise of what? $0.14. Huge beat. And importantly, this is their first profitable quarter since way back in Q3 fiscal 2022.
A long time coming. That profitability story really resonated. Now, on the flip side, revenue. It wasn't quite as strong.
Okay, what was the number there?
Came in at $151.3 million. That was actually a slight miss versus consensus estimates.
And down year over year, too.
Yep, down 7.1% compared to last year. So, it's a mixed picture.
But the market clearly focused on the profit beat, right?
Absolutely. Shares ticked up noticeably in after hours, and you saw a real spike in trading volume. Profitability trumped the revenue miss this time.
All right, so profitability is back after almost 2 years. That's the big win. How did they swing to profit when revenue actually dipped? Seems counterintuitive.
Yeah, it does a bit. The answer is really operational efficiency, getting leaner.
Okay.
The main driver was a big improvement in gross margin. It jumped 180 basis points year over year.
Wow, 180 basis points. What did that bring the total margin to?
Climbed up to 32.5% of net sales. And if you look just at product margins, those were even better, up 210 basis points.
And you said this was intentional, not just luck.
Oh, completely intentional. Management was very clear. They explicitly said they had been buying too much in the past, like way too much.
Right, I remember hearing that. Over inventory kills margins with markdowns.
Exactly. So this quarter reflects a much more disciplined approach. They called it running in chase mode.
Chase mode, meaning less upfront buying, more reacting to trends.
Precisely. Buying smaller batches, closer to the season, sometimes during the season, it cuts the risk of getting stuck with piles of unwanted stuff they have to slash prices on.
Makes sense. Fewer markdowns equals better margins. It's a harder way to operate though, right? Needs a really agile setup.
Much harder. Requires tight supply chains, quick reads on trends. But the payoff, as you see here, is healthier margins. It's a strategic shift away from just chasing volume.
Okay, so that explains the margin side. What about costs? SG&A expenses.
They tackled those too. Selling, general, and administrative costs were down $4.4 million compared to last year.
Bringing the total to
$46.4 million for the quarter, which is about 30.7% of their sales.
And where did those savings mostly come from? Was it one big thing or lots of smaller cuts?
It was pretty broad-based, actually. The biggest chunk, $1.9 million, came from lower store payroll and benefits.
Okay.
Then they had smaller non-cash asset write-offs, about $2.7 million saved there. E-commerce fulfillment labor was down $500,000. And corporate payroll and benefits were down about $0.4 million. So really cuts across different areas.
Even with minimum wage pressures, especially out in California where they have a lot of stores.
Yeah, they specifically mentioned that challenge. So achieving these cuts, despite wage hikes, makes the discipline even more notable. They really tighten the belt.
Okay, so finances look healthier, margins up, costs down. But like you said, revenue was still down 7.1% overall. What's the story with actual sales trends? Are people buying less?
Well, let's dig into the comparable store sales, the comps. For the full Q2, comps were down 4.5%.
Still negative, but better than before.
Exactly. It represents a sequential improvement from Q4 of last fiscal year. So the trend, while still negative, was heading in the right direction.
Did it get better during the quarter?
It did, yeah. It was a bit of a bumpy ride month to month. May comps were down 2%. June actually slowed down. Comps were down 7.6%.
Ouch.
But then July bounced back pretty nicely, only down 3%. So improving through the quarter.
And then came August, which sounds like the real turning point.
August was a standout, definitely. For fiscal August, comparable net sales actually turned positive, up 0.9%.
Finally, positive territory. What drove that?
Mostly the physical stores. Store comps were up a strong 4.5%.
Okay, so people were coming back into the stores. What about online?
E-commerce was technically down 12.1%, but there's a big asterisk there.
Oh, what's the catch?
They made a specific decision about distributing a certain third-party brand, which pulled about $1.8 million in sales out compared to last August.
So not really an apples to apples comparison.
Exactly. If you adjust for that one specific item, e-commerce sales in August would have been almost flat. Not bad.
And crucially, what about the products themselves? Were certain categories doing better?
Yeah, the encouraging sign was that all apparel departments showed positive movement in August. That suggests the core merchandise is starting to resonate better.
That is a good sign. Okay, big picture shift, that there's also new leadership, right? Nate Smith came in as CEO.
That's right. Nate Smith officially took the helm as president and CEO on August 18th.
His background is interesting. Board writers, Oakley, brands with pretty strong youth and lifestyle connections.
Very relevant experience, yeah.
Yeah.
He knows that space. His initial comments were about, quote, doubling down on those things that are working well and looking for areas needing course corrections.
So evolution, not revolution, maybe.
Seems like the initial approach. And Edgy Sheikh, who stepped back in as CEO temporarily to guide the turnaround, is sticking around to help with the transition. So some continuity there, too.
Makes sense. Beyond the financials, how are they trying to connect with that younger audience? You mentioned the TikTok shop.
Yeah, that's a big push. They launched it a few months back. Since Q2 last year, their TikTok following has apparently quadrupled to over 169,000.
Wow, quadrupled. That's significant engagement.
It really is. It's crucial for reaching teens and young adults today. They're also doing more like experiential things.
Like what?
They mentioned an in-store appearance by Travis Barker at one location and a community event with the Mike Tyson Foundation at another, trying to build that brand connection beyond just selling clothes.
Interesting. That authentic connection is key for that demographic, isn't it?
Absolutely. And
Yeah.
the TikTok shop, it's smart. It blends the content they consume with the ability to buy directly. Whether it's driving huge sales yet or just building presence, it's the right move.
Okay, so internal discipline, new leadership, trying new ways to engage customers. What about external stuff? Tariffs are always hanging over retailers. They mentioned that.
They did. For the rest of this fiscal year, fiscal 2025, they expect the impact on product costs to be pretty modest, around $500,000,
How are they managing that?
through mitigation efforts, working with their own brands and third-party partners, adjusting sourcing, sometimes adjusting prices. Some brands are apparently sharing the burden by tweaking wholesale costs, too.
But looking further out, fiscal 2026.
That's more uncertain. They said the situation is fluid, could be a larger impact, but it's too early to quantify. It's definitely something they're watching closely.
Right, always a moving target. Okay, so pulling it all together, improved operations, better sales trend towards the end of Q2, new CEO, but still cautious. What's the actual guidance for Q3?
Yeah, the guidance for the third quarter is definitely cautious. They're projecting net sales between $134 million and $140 million.
And comparable sales.
Comps are guided in a range from down 2% to up 2%. So potentially flat, potentially slightly up or down.
And SG&A, staying tight.
Expected around $47 million, so still showing discipline there.
Which leads to profit or loss for Q3.
They're guiding for another net loss, actually, between $10.5 million and $6.9 million.
So an EPS loss of roughly $11.35 to $11.23.
That's the range, yes. Which, importantly, is better than the negative of 43 cents they posted in Q3 last year. So, improvement, but still predicting red ink.
Why so cautious after that positive August comp? Seems like they're deliberately tamping down expectations.
I think they are, but it's based on history. Management pointed out that August, driven by back to school, is typically their strongest month in the quarter.
Ah, the need-based period, they call it.
Exactly. They said September and October usually see a significant slowdown. It's a pattern they've seen consistently over the last few years.
So they're baking that historical seasonality into the forecast, even with the recent positive signs.
Seems like it. Probably smart for a company still in turnaround mode. Under-promise, over-deliver is likely the strategy.
Prudent, yeah. What else? Store count, still shrinking.
Expect to end Q3 with about 230 stores. That's down from 246 a year ago.
And more closures possible.
Potentially. They have 45 lease decisions to make by the end of the year, so that could lead to more adjustments to the store footprint. Still optimizing.
And cash position, liquidity.
Staying debt-free, which is great. They expect total liquidity between $83 million and $86 million at the end of Q3. That reflects normal seasonal cash flow using cash post back to school, building inventory for holidays. Solid position.
Okay. So the market reaction was positive after hours, shares up. But You mentioned guarded confidence. What did you mean by that?
Well, the stock moved up, yeah, about 8.4% after hours on much higher volume,
Right.
which is good.
But
But the options market was actually pricing in a much bigger potential move, something closer to plus or minus 15%.
so the actual stock move was less than what options traders expected.
Exactly. That sub-implied reaction suggests that while investors like the profit beat and the improving trend, they're not fully convinced yet.
Still in show me mode.
Precisely. They want to see sustained execution.
Yeah.
Can Tilly's keep comps stable or positive? Can they maintain those margins? One quarter isn't enough to declare victory.
Makes sense. And zooming out, how does Tilly stack up against the broader retail sector right now? Are they lagging behind their peers?
Significantly. If you look at something like the XRT retail ETF, it's been performing well over the last year. Tilly's, before this report, was down over 60% year over year.
Wow, a huge gap.
Massive divergence, which suggests there's potential for a significant catch-up or multiple expansion if they can keep this operational momentum going and stabilize sales.
So big potential reward if the turnaround sticks.
Right. And the new CEO is obviously a key factor there. His leadership, especially heading into next year, will be critical. A lot of ground to make up, but the path is clearer now.
Okay, fascinating stuff. Now, time for our favorite segment. As always here at the Deep Dive, we have to remind you, nothing we discuss is financial advice. It's purely for informational and entertainment purposes only. Got it. Good.
Definitely not advice, just ideas.
So with that out of the way, hit us with a wild yet plausible trade idea based on this Tilly's report.
Okay, so given that guarded confidence, that sub-implied options move, despite the clear operational wins and first profit in ages, I'm thinking long TLYS.
Going long. Okay. What's the thesis? Betting the turnaround accelerates.
Kind of. The Q3 guidance, as we discussed, is super conservative. It's based on historical seasonality.
Right. Assumes September, October slow down significantly.
But it might not fully account for the X factor of Nate Smith, the new CEO. His background, his focus on what's working, the leaner inventory, the SG&A discipline, that growing TikTok presence.
You think that combination could maybe override the typical seasonal slump, especially heading into the holidays in Q4?
That's the bet, that maybe things are structurally better now than the historical patterns suggest. The cautious Q3 guide and the market's slightly muted reaction could offer an entry point.
So the play is?
Accumulate TLYS shares, maybe on any dips after this initial pop. Look past the conservative Q3 outlook and anticipate potentially better than guided results, or at least stronger momentum heading into Q4 holiday season.
Betting on improved execution under new leadership surprising to the upside.
Exactly. Target an exit maybe before Q4 earnings are actually reported, capitalizing on potentially improving sentiment as holiday season data trickles out. It's a bet that the market hasn't fully priced in the turnaround potential yet.
Interesting. A debt on execution and the new sheriff in town. Love it. Okay, what a deep dive into Tilly's Inc.
Yeah, definitely a company in transition.
We've seen them work hard to stabilize, getting back to profit through some serious discipline on inventory and costs. Sales trends still tricky, but improving.
And you've got the new CEO, new marketing efforts, real catalysts there. Path ahead isn't easy, but the outlook is certainly more constructive than it was a few quarters ago.
The big question, though, is this sustainable? Can they turn discipline into consistent growth? Or are they just a leaner version waiting for the next big fashion wave?
That's the million-dollar question, isn't it? We'll be a watch.
Remember, everyone, this is purely for your information, definitely not investment advice. For more deep dives like this, make sure you're subscribed.
Thanks for tuning in.
Thanks for joining us on the Deep Dive. We'll catch you on the next one.